Many people wonder why wealthy individuals seem to grow richer whenever the economy collapses and everyone else feels terrified. You watch markets fall, jobs disappear, and everyday families panic while a small group quietly seizes incredible opportunities unseen by others. It feels unfair because economic pain hits regular workers hardest, while investors with resources somehow become stronger through every downturn. During the 2008 crash, property values plunged dramatically, and wealthy buyers acquired homes nearly 40% below previous market levels. In 2020, unemployment spiked rapidly, while billionaire wealth soared as financial markets rebounded faster than struggling households could recover. Today, the richest 1% in America control over 30% of national wealth, while half the population shares only fragments. From 2020 through 2024, several top billionaires more than doubled their fortunes, while millions saw savings shrink significantly. At first glance, it seems like the financial system is intentionally rigged against ordinary people working hard to survive each month. But the truth is far more complicated because wealthy individuals follow principles that regular people were never taught in school. These principles transform recessions from frightening disasters into rare opportunities for building long-term financial strength and independence. In this video, I will uncover the same strategies wealthy investors master so you can apply them confidently during downturns. I am Max, and I have spent years studying how financial cycles transfer wealth from unprepared households to disciplined planners. The goal today is clarity instead of confusion, so anyone can understand recession dynamics without needing a finance background. By the end, you will know how economic storms create chances to buy valuable assets at their most discounted levels. You will also learn why panic pushes buyers away, while wealthy investors walk confidently toward opportunities others refuse to see. Before diving into strategies, let's make sure you truly understand what a recession is in simple everyday language. A recession happens when the economy slows, businesses struggle, and people reduce spending because future conditions suddenly feel uncertain. The National Bureau of Economic Research defines it as a significant economic decline lasting more than just a short moment. Americans have lived through several recent recessions, including the dot-com crash, the 2008 financial crisis, and the 2020 shutdown. Each downturn created widespread stress because job losses rose quickly, while the cost of living continued pressuring household budgets heavily. Yet each recession also produced massive opportunities for people prepared with knowledge, liquidity, and long-term financial discipline. Think of the economy like a heartbeat that periodically slows before speeding up again as recovery strengthens over time. When the heartbeat slows, fearful people pull back while strategic investors move forward and capture overlooked chances. During 2020, the unemployment rate soared above 14%, while investors with cash bought discounted stocks confidently. While millions feared total collapse, disciplined investors quietly positioned themselves for the strongest rebound in modern history. Household wealth in America reached record highs afterward, but most gains flowed primarily to individuals already owning assets. That pattern repeats every cycle because wealth naturally flows toward those holding investments rather than just wages. To understand why, you must learn the 5 key principles wealthy people rely on whenever recession arrives unexpectedly. Principle 1 is called the crisis discount, the extraordinary price drop occurring when fear overwhelms economic logic completely. During calm times, assets trade near fair value because buyers feel confident and sellers refuse to accept lower offers. But during recessions, panic spreads quickly and people sell valuable assets far below their true long-term worth. Imagine the entire economy holding a giant unexpected clearance sale where everything becomes dramatically cheaper overnight. Homes worth $500,000 suddenly list around $300,000 simply because sellers feel desperate. Businesses with strong products drop 60% in stock price, not due to weakness, but widespread investor fear. That is the crisis discount, and wealthy individuals recognize these moments as rare opportunities to buy quality cheaply. Consider Amazon after the dot-com collapse when shares fell over 90% despite strong long-term fundamentals remaining intact. Investors who understood the crisis discount bought shares at extremely low levels and later experienced unbelievable gains. Crisis discounts also appear in small businesses, rental properties, and online ventures when owners panic about sudden downturns. But not every discounted asset is a treasure. So understanding the difference between temporary fear and true failure is essential. You must evaluate whether the asset will survive 10 years, because discounts only matter when fundamentals stay strong. Principle 2 is the liquidity advantage, the power of having cash ready while others desperately need money now. Most people dislike holding extra cash since savings accounts feel slow, and inflation slowly reduces purchasing power yearly. When markets rise, everyday investors chase fast gains and invest nearly everything, leaving no emergency cushion available. But when recession strikes, those fully invested individuals face immediate pressure to sell investments at terrible prices. A person with no cash reserves must liquidate assets during downturns, locking in losses permanently instead of waiting patiently. Meanwhile, wealthy investors deliberately hold liquidity because they know downturns offer rare chances requiring immediate capital deployment. They sacrifice small gains during good times to maintain flexibility when the best opportunities finally appear unexpectedly. Liquidity transforms recessions from dangerous threats into strategic buying seasons filled with discounted long-term investments. Even modest emergency funds create tremendous power because they prevent forced selling during moments of market panic. Liquidity also gives you emotional stability, letting you think clearly instead of reacting impulsively when markets collapse rapidly. Principle 3 is income insurance, the financial protection created by having multiple income streams supporting you during downturns. Most Americans rely on one paycheck, meaning a single job loss instantly destroys their entire financial stability and confidence. Wealthy individuals build several income sources so one slowdown never threatens their overall lifestyle or long-term financial plans. They may combine salaries, rental payments, dividends, online businesses, royalties, or partial ownership in various growing companies. When recession hits, one stream might weaken, but the remaining streams continue flowing, providing essential stability and resilience. This creates financial breathing room, allowing them to remain patient while others panic and make emotionally driven mistakes. Even small extra income sources help dramatically by reducing pressure when markets fall and uncertainty grows across the economy. A simple freelance project, weekend gig, or online service can provide enough support to avoid selling assets prematurely. Income insurance protects your long-term investments and lets you seize discounted opportunities others cannot safely afford. Principle 4 is the knowledge gap, the surprising difference in financial understanding between wealthy investors and everyone else. Schools rarely teach practical finance, so most people enter adulthood without understanding assets, liabilities, or long-term investing. Without knowledge, people panic during downturns because they cannot distinguish normal volatility from genuine economic deterioration. Wealthy individuals spend years learning business fundamentals, allowing them to identify undervalued opportunities hidden beneath fear. They examine cash flow, debt levels, and profitability instead of reacting emotionally to temporary price changes appearing alarming. Imagine a car auction filled with frightened sellers where inexperienced buyers cannot recognize quality vehicles beneath surface damage. A skilled mechanic sees value others miss, purchasing reliable cars cheaply because knowledge reveals truth beneath appearances. Financial knowledge works similarly, helping you determine whether an investment is temporarily discounted or permanently broken. People who lack understanding rely on headlines or rumors, often selling good assets simply because everyone else panics. Building financial literacy empowers you to act rationally during chaos and recognize opportunities easily overlooked by crowds. Principle 5 is the patience paradox, the powerful idea that long-term waiting often creates faster wealth accumulation. Our culture promotes instant gratification, making patience feel uncomfortable even though it remains essential for investment success. Wealthy individuals can hold investments longer because they possess savings, stability, and structures supporting long-term decisions. They are not forced to sell during downturns, allowing them to wait calmly for eventual recovery and renewed growth. Most people sell too early because financial pressure or emotional stress makes temporary losses feel permanent and overwhelming. But patient investors understand market cycles naturally move between expansion, decline, stabilization, and powerful recovery phases. They remain confident because history consistently shows markets rebound even after devastating downturns that appear catastrophic. Warren Buffett demonstrated this during the 2008 crisis when he invested heavily despite widespread panic and uncertainty. His investments temporarily declined further, yet his long-term patience generated billions once markets recovered and strengthened. The patience paradox reveals that waiting is easier when your financial foundation prevents fear from guiding your decisions. When you combine patience with liquidity and knowledge, recessions shift from terrifying moments to extraordinary wealth opportunities. Now let's illustrate these 5 principles using a detailed story comparing two individuals with similar backgrounds and incomes. Meet Alex, a hardworking 32-year-old marketing professional living in New York, earning a comfortable $75,000 salary. During market booms, Alex invested aggressively, chasing quick gains in tech stocks and cryptocurrency without building emergency savings. He felt confident because markets climbed rapidly, convincing him downturns were unlikely and risk management seemed unnecessary. Alex also accumulated credit card debt, believing future investment returns would outpace interest payments easily without difficulty. When the economy weakened, Alex faced sudden layoffs, leaving him unemployed and emotionally overwhelmed by financial uncertainty. His investments crashed nearly 60%, forcing him to sell everything at the bottom just to cover living expenses. Alex felt embarrassed and defeated, watching years of savings collapse because he lacked liquidity, income insurance, and patience. Meanwhile, meet Mia, another 32-year-old professional earning the same salary but managing her finances intentionally differently. Mia built a 6-month emergency fund, invested gradually into index funds, and maintained a small online freelance business. Okay. When layoffs reached her company, Mia also lost her job, but her financial safety net immediately softened the emotional shock. She continued earning modest freelance income and avoided selling any long-term investments during market volatility and uncertainty. Instead of panicking, she slowly purchased additional shares at discounted prices, taking advantage of temporary crisis valuations. Mia understood the crisis discount and recognized market downturns as rare opportunities to buy valuable assets far cheaper. Within 2 years, her portfolio recovered strongly, and the discounted shares she purchased nearly doubled in overall value. Mia later used her stable foundation to acquire a small rental property priced significantly below its previous market value. Meanwhile, Alex spent those same 2 years rebuilding lost savings because selling early erased his chance for recovery. Both individuals earned similar incomes, but their outcomes diverged dramatically because their structures and mindsets differed significantly. Mia combined liquidity, patience, knowledge, and diversified income, which transformed recession into a powerful launching moment. Alex entered recession unprepared, making desperate decisions driven entirely by fear, which prevented long-term financial progress. Their story proves recessions do not create inequality alone. They simply expose financial habits quietly shaping outcomes long beforehand. Individuals who prepare thoughtfully experience downturns as temporary slowdowns rather than devastating disasters, destroying financial security completely. Many people mistakenly believe wealth grows through constant lucky breaks, but real wealth grows through disciplined preparation before disasters strike. Recessions accelerate the effects of good or bad financial habits, capable of widening the gap between households almost instantly. Mia's patience and preparation allowed her to stay calm during uncertainty, while Alex's stress intensified every passing week dramatically. This contrast highlights why recession outcomes depend less on income size and far more on foundational financial structures. Knowledge, liquidity, and diversified income streams create stability, allowing you to avoid costly emotional mistakes under pressure. Emotional decisions often destroy years of progress because fear convinces people to protect short-term comfort over long-term success. Meanwhile, disciplined investors stay focused on future growth. Understanding temporary declines rarely determine long-term financial outcomes. To navigate recessions successfully, you must build a foundation enabling you to think clearly when everything feels uncertain. This foundation begins with an emergency fund covering several months of essential expenses, providing critical financial breathing room. Emergency savings protect you from forced selling, which turns temporary market drops into permanent unrecoverable losses. Even a modest emergency fund drastically improves emotional confidence because you no longer depend on panic decisions. After securing liquidity, focus on learning basic financial concepts so economic news no longer feels confusing or overwhelming. Understanding assets, liabilities, valuations, compounding, diversification, and cash flow helps you evaluate opportunities rationally during chaos. Financial literacy removes fear by revealing patterns, showing downturns are temporary, and recovery often brings strong growth. Next, begin building additional income streams so one job loss no longer threatens your entire financial stability. Side income can start small through freelancing, delivery apps, tutoring, online services, or selling digital products creatively. Even a few $100s monthly can prevent financial collapse and protect long-term investments during stressful periods. Once you have liquidity, knowledge, and supplementary income, you can begin investing consistently with confidence and discipline. Consistent investing helps you build long-term wealth gradually, regardless of temporary market swings and negative headlines. The key is maintaining emotional stability so short-term volatility does not push you into harmful panic decisions. Remember that every major recovery historically began during periods when investors felt the most uncertain and fearful. People who buy when fear dominates typically experience the strongest long-term returns once conditions eventually improve. It is uncomfortable buying during downturns, but history consistently rewards those who remain patient through difficult periods. The financial system naturally rewards patience because it transfers assets from impatient sellers to patient long-term investors. This transfer intensifies during recessions when people sell valuable assets cheaply, simply to relieve their anxiety. But investors with strong foundations wait calmly, knowing temporary declines create life-changing opportunities for future growth. Understanding this dynamic lets you see recessions not as threats but as rare windows for significant financial advancement. To increase your recession readiness, visualize how each principle strengthens your ability to withstand economic pressure effectively. Crisis discounts offer discounted assets. Liquidity provides buying power. Income streams add security. Knowledge guides decisions, and patience captures recovery. When combined, these principles transform recessions from frightening experiences into moments of extraordinary strategic potential. Most people underestimate how much long-term success depends on decisions made during chaotic economic periods. Moments of panic often shape financial futures more dramatically than years of stable, predictable economic conditions. Building your foundation now ensures the next recession becomes an opportunity instead of a painful setback. Preparing before problems arise is vastly easier than trying to recover after panic-driven financial mistakes. Even small, gradual improvements today create major advantages when future downturns inevitably appear again. Economic cycles are normal, predictable, and unavoidable. The only variable is how prepared each household becomes. Instead of fearing recessions, shift your focus toward building structures enabling you to navigate them confidently. Preparation gives you control while panic removes control, creating opposite long-term outcomes for similar starting points. Many financially stressed households could transform their situation simply by improving one or two foundational habits. The sooner you strengthen these habits, the faster your financial resilience grows before the next downturn arrives. Start with simple steps because small improvements compound into major lifestyle and wealth changes over time. Commit to learning consistently so financial knowledge becomes natural rather than intimidating or overly technical. Commit to saving consistently so your liquidity grows gradually, providing emotional safety and investment flexibility. Commit to building income streams so financial pressure decreases and opportunity awareness increases during uncertain times. Commit to investing consistently so market volatility becomes manageable instead of terrifying or emotionally exhausting. Commit to patience so you can hold through downturns and capture the full strength of eventual recoveries. These commitments transform your financial identity from fearful observer into confident strategic participant during recessions. Once you adopt these principles, downturns no longer feel like threats but rather invitations to build meaningful wealth. Recessions become turning points where individuals with preparation rise while those unprepared struggle through overwhelming financial pressure. The path you follow depends entirely on whether your habits strengthen or weaken your ability to remain calm. People with strong foundations experience downturns as temporary challenges rather than permanent disasters shaping their future. Their mindset shifts from fear toward opportunity because preparation allows them to think clearly when others panic. They recognize downturns happen regularly, meaning every cycle offers another chance to accumulate assets at discounts. Instead of asking, "Will recession happen?" they ask, "How ready am I for the next inevitable downturn?" Prepared individuals understand recessions are unavoidable and use them to accelerate long-term wealth and financial security. They rely on systems rather than emotions, following predetermined rules for saving, investing, and managing risk responsibly. Systems reduce emotional decision-making by ensuring consistent behavior, even when markets behave unpredictably or frighteningly. Consistency becomes your superpower because disciplined habits eventually outperform chaotic decisions influenced by fear. During downturns, people often obsess over short-term losses instead of focusing on long-term wealth-building opportunities. But perspective changes everything because what feels disastrous today may become the foundation of tomorrow's prosperity. Look at past recessions and notice how every decline eventually led to strong periods of renewed economic growth. Investors who stayed patient benefited from those recoveries while impatient sellers missed the rebound entirely. This pattern repeats because human behavior remains predictable. Fear causes selling and patience leads to recovery. Recognizing these predictable patterns helps you avoid repeating common mistakes made during every economic downturn. One common mistake is treating recession like a permanent collapse, even though history shows recovery always follows. Another mistake is assuming market declines reflect fundamental destruction rather than temporary emotional reactions. People often forget markets decline faster than economic fundamentals change because panic accelerates downward pressure. Meanwhile, long-term investors remind themselves that underlying businesses rarely change overnight during financial turbulence. Even strong companies experience large temporary price drops, despite maintaining healthy operations and profitable long-term potential. Recognizing this difference helps you stay invested confidently while others sell valuable assets out of fear. Staying invested through downturns matters because missing recoveries drastically reduces long-term wealth potential. Many investors panic and sell near the bottom, then buy back later after prices rise again. This behavior locks in losses permanently and prevents individuals from benefiting when markets eventually rebound. Preparing emotionally is just as important as preparing financially because fear intensifies without proper knowledge. Emotional resilience grows when you understand volatility is normal rather than dangerous or personally threatening. Market downturns feel painful, but rarely represent permanent financial ruin for patient long-term investors. The key is ensuring your portfolio and savings empower you to hold instead of forcing panic selling. Forced selling destroys wealth faster than nearly any other financial decision during stressful economic periods. That is why liquidity, income diversification, and emergency savings matter more during recessions than market predictions. No one can perfectly predict downturn timing, but everyone can prepare strong foundations before uncertainty arrives. Preparation reduces anxiety significantly because you know your survival does not depend on short-term market movements. With preparation, you react calmly, avoid major mistakes, and act strategically when opportunities appear unexpectedly. Without preparation, fear becomes overwhelming and decision-making collapses under pressure from financial instability. Every recession deepens the divide between prepared and unprepared households depending on the strength of foundations built. But the encouraging truth is anyone can shift categories by gradually adopting disciplined financial habits. You do not need high income to prepare. You only need consistent actions executed reliably over time. Small improvements compound powerfully, turning modest savings into long-term stability and eventual financial independence. Wealthy people succeed because they started preparing early, not because they experienced fewer recessions or hardships. They learned from past downturns and designed systems protecting them from emotional and financial instability. You can build similar systems today using the same simple principles guiding wealthy investors through every recession. Begin with liquidity because cash creates confidence, flexibility, and opportunity during stressful times. Build additional income streams so financial pressure decreases and your ability to act strategically increases dramatically. Expand financial knowledge continually so your decisions rely on understanding instead of fear, rumors, or guesswork. Develop patience by viewing investing as a long-term journey rather than a quick attempt to beat the market. These principles require discipline, but they reward you with stability, resilience, and long-term financial growth. The earlier you begin applying them, the more powerful your results become throughout future economic cycles. The next recession is inevitable, but your financial future depends on how prepared you are before it arrives. Preparation transforms unpredictable downturns into predictable opportunities for building meaningful long-term financial strength. Most people will experience several recessions in their lifetime, meaning repeated chances to improve financial outcomes dramatically. Each cycle gives you another opportunity to practice calm decision-making and strengthen long-term financial resilience intentionally. Whether recessions hurt or help you depends entirely on habits built long before the downturn actually begins. Financial habits shape emotional reactions, and emotional reactions often determine whether individuals recover or collapse financially. People with disciplined habits respond with strategy, while people without preparation respond with panic and desperation. Panic-driven decisions usually involve selling assets, increasing debt, or abandoning long-term plans prematurely under pressure. Strategic decisions involve saving cash, investing patiently, preserving assets, and seeking discounted opportunities confidently. Recessions expose hidden weaknesses in finances, but also reveal strengths built through consistent daily habits. Strengthening weak areas today prepares you for the next downturn long before headlines announce economic trouble. Improving your financial life is not about perfection. It is about progress, consistency, and practical awareness. Quorum. Every dollar saved strengthens liquidity, every skill learned enhances income potential, and every investment compounds over time. Building these habits creates momentum, turning personal finance into a predictable long-term system rather than chaotic guessing. Once your system is strong, recessions lose their power to intimidate you or disrupt your future plans. You will view downturns as natural cycles instead of uncontrollable disasters threatening your stability or lifestyle. This mindset shift is life-changing because confidence replaces fear and clarity replaces confusion during uncertainty. Confidence leads to smarter decisions, which compound into greater wealth over months, years, and decades ahead. People often overestimate short-term risks while underestimating long-term gains created by disciplined financial behavior. When you trust your system, fear becomes manageable and opportunities become easier to recognize and evaluate. Fear blinds investors to bargains, but preparation reveals them clearly even during chaotic, unpredictable market conditions. This ability to recognize value during crisis separates long-term wealth builders from overwhelmed emotional sellers. Recognizing value requires patience, clarity, and confidence. Skills strengthened through consistent practice and daily discipline. Once these skills develop, downturns become strategic opportunities rather than terrifying threats to financial survival. At that point, recession becomes a powerful wealth-building event instead of a destructive financial catastrophe. You will no longer fear temporary declines because you understand recovery and growth usually follow with strength. This shift empowers you to stay invested, keep saving, and continue building wealth despite negative headlines. Over time, these consistent actions place you in the same category as disciplined investors who thrive during recessions. You do not need to be wealthy to begin. You simply need willingness to prepare before uncertainty arrives. Recessions punish unprepared households, but reward disciplined individuals who embrace long-term thinking and patient strategy. Every recession transfers wealth from people who need cash immediately to people who built strong foundations earlier. Ask yourself which side of that transfer you want to stand on during the next economic downturn. Do you want to react with urgency and fear or respond with confidence and strategic preparation? Your answer depends entirely on whether you begin building your financial foundation today rather than waiting. Waiting leaves you vulnerable because uncertainty arrives without warning and rarely gives time for preparation. Starting now positions you for resilience, helping you navigate future downturns without sacrificing long-term goals. Build your emergency fund so unexpected obstacles do not force you into stressful and damaging financial decisions. Learn basic investing so markets feel understandable rather than intimidating when volatility inevitably increases. Create at least one additional income stream so economic pressure never pushes you into selling prematurely. Practice patience by focusing on long-term growth instead of short-term fluctuations caused by unpredictable headlines. These steps give you control, confidence, and clarity even when economic conditions become uncertain and stressful. While others panic, you will remain grounded and capable of acting strategically throughout difficult financial periods. Over several years, these habits create noticeable differences in stability, opportunity, and long-term financial confidence. Eventually, your resilience becomes stronger than any recession because preparation transforms uncertainty into predictable opportunity. The 5 principles: discounts, liquidity, income insurance, knowledge, and patience form the foundation of recession success. Mastering them allows you to turn downturns into stepping stones, elevating your financial future steadily upward. These principles apply to every investor regardless of age, income, background, or previous financial challenges experienced. Your long-term progress depends on consistent daily actions rather than complex strategies or risky decisions. Begin preparing now so the next economic downturn becomes your opportunity to grow stronger instead of weaker. Recessions will continue appearing throughout your life, but your reaction can evolve with intentional preparation. Build your foundation today so future recessions empower you rather than overwhelm you emotionally or financially. The next recession is coming, and your choices now determine whether you panic or prosper when it arrives.